I'm trying to reconcile an idea from thermodynamics, and that is that you have the laws of Boltzmann, which are probabilistic, which says that you can't really tell what certain molecules are doing in a gas, but what you can do is you can probabilistically assume where they go in aggregate. And I want to reconcile that with investment theory or with the ideas of investing because it feels to me very similar. And the word is thesis-driven investing. So thesis-driven investing is very common in the hedge fund world, equivalent of the Boltzmann rules of gases, where you don't have a good sense for what individual companies will do, but you have a probabilistic view of where things are going. I personally think thesis-driven investing is a dangerous path for investors. I've said that in my memoirs when I talk about thesis-driven investing, where I'm saying that there's a sentence where I say logic is a dangerous companion of a hedge fund manager, often very useful, but also deceptive. So you got to be careful with that. And I talk about the semantic gap in my memoirs quite a bit. I think it's one of the big themes of the last third of the book, where we talk about Orange Capital Partners. I think the semantic gap, which is sort of your logical understanding of the world, your deterministic frontal cortex type of understanding of what's happening, and then the actual thing that's happening. And I think you want to close that gap as an investor. And to me, I'm borrowing from Boltzmann because the problem of thermodynamics, particularly in the 20th century, early 20th, and actually even a second half of the 19th century, the problems were that we just couldn't understand the actual development of molecules, let's say, in any kind of gas. But we had a probabilistic theory. So we can, for example, we can say that water above 100 Celsius most probably will turn into gas, right? Most probably. But there are molecules that turn into gas even at room temperature, and there are molecules that don't turn into gas even above 100. And that's because of this Boltzmann probabilistic approach to, or that's how we understand, excuse me. We try to explain it with probabilistic reasoning. And there is an interesting explanation for why potentially the gases or the rules of gas or the laws, I'm not sure if they're rules or laws, the Boltzmann rules or Boltzmann laws of gases, I want to call them rules. It's not clear if they are actually fundamentally probabilistic or just probabilistic because we don't know any better. And the explanation comes from quantum mechanics and basically says that because of entanglement, we don't have enough information going one way, and we also can't go back, meaning once we have, let's say, a gaseous form of water, we can't exactly reproduce, let's say, one particular molecule back to its original state before we started the experiment, and that's because of entanglement. In other words, time doesn't commute. And that to me is another incredibly interesting point for the investment world. Does time commute? Can I take Tesla today and reproduce the originals of Tesla and go back and forth, or is there a quantum effect here or some sort of entanglement or something which makes the path probabilistic fundamentally? This is the Not Even Wrong podcast. February 25th, 2023. This is Krim Delco. It's a Saturday. There's no update. For the year, we are up 61%. The market's up 3.6%. We're outperforming by 56.5%. Just before I go into the conversation today, I just want to give a quick overview of the markets. I think we have not so good inflation reads across the board. CPI, PPI, personal consumption index, all these numbers are showing a little bit higher than expected inflation. In other words, we still have inflation. Interest rates have gone up. The 10-year Treasury is almost 4% again. So we're back to square one, actually, and it's interesting to see how the markets will react to that. I think we probably are embracing ourselves for a lot more volatility now because we had this big move in treasuries from 3.6 to 4% yield in the 10-year. I think what's happening is the Fed just is not going to budge, and they shouldn't, because inflation's high. In our opinion, inflation's high because the government is not doing its part in reducing inflation. There's still way too much spending, way too much waste, and more importantly, also politically, there's way too much leeway, let's say, in labor laws, and people are not going back to work, and people are finding excuses not to work, and all kinds of things like that are still way too prevalent. I think people just are not feeling enough pain, and as scary as it sounds for us being fully invested, in fact, even having 12% leverage in the portfolio, I think we're going to have to deal with some more pain. Hopefully that the market will anticipate a recovery much sooner than the actual recovery comes. So the sooner we have potential for recovery, we will have a recovery in the market much sooner than that. Now, how does that work? What are the mechanics of a recovery? I think it starts with politics. If we have a Republican Congress that we have now controlled by the Republicans, hopefully they can rein in on spending. Hopefully they can get Joe Biden to waste less money and also politically put himself in a position where he can impose better, let's say, labor laws, or maybe not laws, but more of this woke climate of I want to be heard and I want to do this and I don't want to contribute kind of thing. That has to stop. There's nothing wrong with sharing wealth, sharing opportunity, including people that were excluded into the labor force or into the wealth creation process. I'm not against any of that. In fact, I'm for all of this, but not at the expense of a voluntary exchange of capital and labor and ideas and the process that we call capitalism, for lack of a better word, where entrepreneurs, owners, and ownership capitalism drives progress, because that's the best system we know, and we can't jeopardize that for some sort of pseudo socialism or whatever has been lingering ever since the pandemic took over not just the physical but the minds of people. And hopefully that can be eradicated sooner than later, because that's when the recovery will happen in the market. We have lots of innovation. We have lots of interesting concepts such as transformers and language models, which are bringing new ideas to the AI front that could be used in not just language models, but in general. We have the innovations in aerospace by SpaceX. We have innovations on electric vehicle technology and self-drive technology, charging technology, solar technology, and distributed solar technology by Tesla, and therefore also give us a lot of reason to be optimistic about the future. Now let's talk about this particular episode in the memoir. This is the second episode of an excerpt from Love Story, a memoir by Krim Delko, my memoir. As I said in the first episode, I'm going to bring more excerpts from my memoir into this podcast series, because now it's the last third of the book, talking about my previous 15 years as a hedge fund manager or Orange Capital Partners. So now the rubber really meets the road as far as this podcast series, the Not Even Wrong podcast series is concerned, which the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So what better way to introduce people to the life of a hedge fund manager than give them a glimpse of the previous 15 years of my life, where I was actually running a hedge fund and where I've been having to take risk and dealing with all of these issues that make this job the most exciting job, and probably also one of the toughest jobs out there. So this particular concept now, today, the big phrase here is thesis-driven investing. So let's start with that. What is thesis-driven investing? It's a common thing that you see in the hedge fund industry, which is people build a thesis. Let's say the thesis is China requires more commodities, and therefore natural resources around the world will gain in price. Another thesis is 3D printing will change the manufacturing processes around the world. Another thesis is that electrification of the car industry will drive battery electric vehicles. So those are the kinds of theses that you hear. Now, a thesis is, I think it's a dangerous path for investors to go for several reasons. First, I think the word thesis is simply a misappropriation of a word, because the thesis in scientific terms, and that's where this term is borrowed from, a thesis is a premise which leads to something else. So you say X, and then from X you derive Y. That's number one, which is very difficult to do in investing. And B, it has to be testable, another very, very difficult thing to do in investing. Therefore, I think thesis-driven investing, I think it's a slippery path for hedge fund managers, and therefore should be avoided. We've fallen into that trap ourselves, particularly when we started in the in the late noughties. It was just before the 2008 financial crisis, and thesis-driven investing was all over the place. In particular, the kinds of theses that you would hear, let's say George Soros was a very prominent, his fund and himself were talking about China and soft commodities. Hugh Henry was talking about that. And then Henry actually changed the thesis to China is in oversupply of everything and everything will collapse and so on and so forth. You can look, the thing with the thesis, it's a bit like the broken clock, right? Every now and then it's right. Like a broken clock is right twice a day. So you can then say, well, you see, I had this thesis, for example, take Hugh Henry. I mean, he was, if you ask me, he was one of the most interesting and inspiring people that I've met on the hedge fund circuit. In fact, he is the inspiration for this podcast series. His podcast, the name eludes me now, is what I'm basically what made me do this, and then I've been doing this for the last 3.5 years, and I'm very happy about doing this. The point here is this: you can have a thesis like let's say Hugh Henry saying China is doing this, China is doing that, and then the real estate there is overpriced, and short this and short that, and in this whole mess of having a sort of a logical deterministic narrative, and the discrepancy between that and the actual pricing in the market can lead you to give up, which is what happened to Henry. I think that's why it's very dangerous. So thesis-driven investing is dangerous in many ways. One, I think for yourself as a fund manager, you really start believing in your own stuff. And like the famous quote from Scarface, don't get high on your own supply. Don't get high on your own supply. Well, but what does that mean? You can have a thesis or a narrative for your PowerPoints to pitch to investors. That's not a bad thing, because people like narratives, and it's often easier to explain to them what you're actually doing. But be very careful not to believe your own words. You have to be a lot more subtle than following your own thesis when it comes to investing. And that's because of the semantic gap between your logical narrative surrounding the world and the actual narrative on the ground. So there's a good example in my memoirs. I talk about Carlsberg, right? Now, Carlsberg, we met the CFO of Carlsberg in the summer of 2008. And had we invested, or we have not invested in the company. Had we invested in this company, we would have made a decent return. Not great, but would have made a decent return. But the point is, back then, the thesis would have been, this is the short of the century. Why? They just had invested a massive amount of money into a Russian beer company. Russia is notoriously bad to be exposed to, period. But having a financial crisis in 2008, having people like Putin running the country, and then having them also, by the way, backlashing against alcohol. And then on top of that, we had recently the invasion of Ukraine. Now, of course, we couldn't know all of this, but my point is, you could have made a thesis which sounded very, very logical and very intelligent back then to at least not invest in Carlsberg, if not short the stock. And let's say, I think a lot of long short funds, actually, that's what they would have done. They would have bought, let's say, Bud and Heineken and shorted Carlsberg. And that would have been a terrible trade. Bud, as a company, has done nothing over the last 15 years. Carlsberg has doubled, and that doesn't account for dividends, so let's leave that outside. And the reason this is happening is because of the semantic gap, right? If you really want to, one thing is to have narratives. One thing is to talk about, again, tell stories about, well, this company is doing this and that, and that, and that. and the actual investment process and the actual business on the ground. There's a big, big gap there. And it's the job of an investor to close that gap. Why has Carlsberg done well? Because they are incredibly good at acting out near monopolies for themselves. And they're incredibly good at what Peter Thiel calls P times Q, which is you might have a market size of P, and even if that market shrinks, doesn't matter. As long as Q, which is the share of value that you get from that market, is steady or even increasing, you are generating wealth and you're making money for your shareholders, and that's all you need to know. So this is what happened to Carlsberg, and this is how we personally feel about, generally, how we feel about investing. And this is a process that you have to learn over years and years of investing. And hopefully this podcast series and the book can help people who are new to this world to maybe accelerate their process a little bit. Like in every other field, I think us who've been around for years, it's our duty in a certain sense, at least, to provide knowledge to the next generation. I think it's just how life works, and I want to be part of this process. So again, closing the semantic gap, very important. Now, what am I talking about in this particular episode? Like I said in the prelude, I want to reconcile an idea from thermodynamics with the investment world. The idea from thermodynamics stems from the Boltzmann rules of gases, which is basically a probabilistic way to look at gases, which means, in a nutshell, we can say, look, we don't know exactly what each two molecule does in water, but we have a good sense that the probability that a thing will turn into gas after 100 Celsius, that's very high probability. So we have probabilistic views of the world, and it's a very useful rule that helps us, do physics and lots of things. Now, in investing, there's a similar thing, and I think the thesis-driven investing, I would say, is sort of the equivalent of the Boltzmann rule in gases, which is, look, we don't know exactly what's going to happen on the ground. I don't know exactly what's going to happen with a company X and Y and so on and so forth. But I have a good sense where the aggregate is going and how, let's say, environmental changes and how environmental information will change the dynamics. So if I have, let's say, like we have right now, the 10-year going from, let's say, we have the 10-year going from, 2% to 4%. If we have something like that happening, then, how will the rest of the market change? And there's a thesis, let's say all growth stocks will not do well. This is the sort of Boltzmann style investing where you have a probabilistic prediction for the aggregate. But the question, of course, for the investor, and this is why I think to outperform, to generate alpha in the market, you just can't do that. You have to have a different approach. Now, we in the memoir, I talk about solution-driven investing, which is instead of having this Boltzmann style aggregate view and probabilistic view of the world, I try to be more solution-driven. What are the problems and how can I solve those problems? This is in general what we're trying to do at Orange Capital Partners. Now, that in itself, of course, warrants a whole new episode, if not a whole new book, in the sense that, what is a solution? What is a problem? How do you define a problem? How do you define a solution to a problem? And then once all of this is said and done, you also have to ask yourself, okay, who's going to make money in this whole process? So there's a lot of things to be said around all this. And I don't want to go there now because, again, this would make this episode way too long. But my point here is that I want to formulate the idea, which is very important, that there is a Boltzmann rule of gases and that is translatable to investing, where we have thesis-driven investing, very similar, where we have probabilistic predictions of the world instead of deterministic single deterministic paths of, let's say, companies or assets in general. That is helpful, but it's not enough to differentiate yourself in the market. The same way it's not enough if you just say, look, molecule X will probably turn into gas at 100 Celsius. Everybody else knows that. Every high school student knows that, even middle school. But if you can predict how a certain molecule will do, once you get to 110 degrees and say, well, this particular molecule actually will not. And if you could do that, that is real alpha in physics as much as it would be if we use the analogy now in companies. This is the idea. And then just lastly, I want to mention one explanation for why the Boltzmann rule actually might be fundamentally probabilistic, which is the entanglement, the idea of entanglement, and that you have, when you go from, let's say, time 0 to time 1, you can't reverse it. It doesn't commute. Quantum physics doesn't commute, right? We know that, quantum mechanics. So you can go this way, but you can't go back. It's not 2 times 3 is 2 times 3 is 3 times 2. It's not how it works in quantum mechanics. And the question is, how is that in investing? It's an interesting question that I want to leave open for now, but my guess is that it's very similar and that it has to do with the same concept of entanglement, even though, of course, in the big world of investing and companies, entanglement has a very different character. But as a concept, as an idea, I think it's worth mentioning and thinking more about it. Thank you.